Hello everyone and welcome to our final wrap-up for 2019. It's early December at the time of recording now, and we've seen quite a lot happening in the last month. Some of the obvious ones are things like South African Airways going into business rescue. We think on the whole that's actually positive. It now draws a line under how that business is being run, and hopefully they'll be able to turn it around. But it also sets somewhat of a precedent for the other state-owned enterprises, which we're pleased to see. The big thing happening at the moment, obviously, is Eskom. On my way here this morning, we are at stage 4 in terms of load shedding. Last night went to stage 6 for the first time ever in South Africa. Eskom is a big problem. The current problems are actually a confluence of things, some of them incompetence or poor management, and some of them are things outside of control in terms of 3 power stations having been flooded by floods that are a 1 in 100-year event. But nonetheless, Eskom is the thing that will hold back our economy from growing. The third quarter GDP numbers actually came out and were negative. They were lower than expected and they were negative. So we started this year having expected economic growth in South Africa to probably be around 1.5%, and they were continually cut back. And now the expectation for the year is that maybe we'll get to 0.5% growth for the year as a whole. That'll be the 5th year in a row where we've had sub 1% growth from a South African point of view. The weak economic performance in South Africa we've just spoken about has increased the probability of a credit ratings downgrade. We expect now that will actually happen after the budget in February, and South Africa will then be rated as junk status across all ratings agencies. We think that's been priced into the bond market already. Our bonds are looking too cheap, even compared to other countries that are way below us in terms of their credit rating. We do still expect that from these levels of around 14.60 to the dollar, we may see the rand weaken on the announcement of that downgrade. This is unfortunate, but we think it's one of those things that actually once it's out the way, we'll see the markets normalize and kind of get on with things. The downside is really that it means that our government lending will cost them more, and that means there's less to spend on infrastructure development, on social grants, and looking after the poor in this country. We have been in junk status before, and it's something that will take time to rectify and get out of that into the coming years. Having mentioned the downgrade, it's important to realize that our portfolios are well diversified, all of them having substantial offshore exposure, and even the exposure to South African listed shares. Those companies have international markets that they're working into, and over 70% of the top 40 shares in South Africa, their profits, or 70% of their profits, come from outside of the borders of South Africa. This makes sure that the portfolios can handle movements in our currency and protects us against the currency weakening over time. So having looked at the economic background, the most important thing is how does that feed through into our portfolios. Economic growth and company profits are actually not very well correlated. In other words, companies are often still able to grow their profits even though economies may be struggling. And we've been in South Africa through a period of really struggling economic growth. If we look at the All-Share Index and companies on that index over the last year to the end of October, they've actually grown their earnings on average by 16.5%, despite the prior year being poor from an economic growth point of view. That's an indication, again, of companies actually being able to tighten their belts, to do things smarter, and still to grow profits. And that will feed through into share prices ultimately. So if we look at the markets this year, they actually haven't been bad. We would always like them to be stronger, but if we look at the year to date, the equity market is up almost into double digits. Bond market is up. Globally, global equity markets have been really strong, in excess of 20% so far this year to date. So we've seen a reasonable uptick in returns. We're still not at levels where we expect over the long term, and because of that, our expectations looking forward for portfolio returns are actually quite positive. So 2019 has been a tough year economically. Lots of things going on there. But if you look at the markets have actually been reasonable this year. We've seen some reasonable growth from the local equity and bond markets. We've seen some very good growth from the global equity and listed property markets, and that's resulted in some nice pickup in the portfolios during this year. This has been good compared to 2018, when markets were actually quite negative, both locally and internationally. If we have a look at this in context, it just reminds us again of sticking to long-term strategies. Investors who became too negative at the end of last year would have locked in losses, whereas investors who stuck to their long-term strategies have been rewarded in 2019. From a personal point of view, those of you who celebrate Christmas, I hope you have a blessed Christmas and a good time celebrating that holiday with your families. For those of you who are going away and taking a break, I hope it's a good one and you come back well rested to take advantage of all the opportunities that 2020 will bring us. Thanks again for your business, and thanks for watching this. As always, if you've got questions, please feel free to give us a call. Our office will be closed between Christmas and just after New Year, but I'm sure you have your advisors' mobile phones. If there's anything really urgent, you'll be able to get hold of somebody. Thank you. Bye-bye.